What we're gonna be doing, we're gonna be using this, what you have in your hand and what's posted up here as an example, right? But I'm gonna be talking to you about some things also that's probably not on this paper that you're probably gonna see in your exam. And we're gonna be doing a review based upon chapter 1, chapter 2, and chapter 3, because your test is gonna be over those 3 chapters. The one thing you gotta know when we do an accounting is that accounting is on what kind of a basis? Accrual basis, absolutely. So on the accrual basis, they do have a basis called cash basis, but that's non-GAAP. So remember, cash basis is not GAAP. It's the accrual basis that's GAAP. And then accounting is based upon this framework, like this framework of debits and credits. And we know every time we do a transaction, we have to have what? At least how many accounts? 2. Have to have at least 2 accounts when you're doing a transaction. And you did this in chapter 1. You did an analysis, right? When you looked at the, what do you call it? The accounting equation. I remember the accounting equation? When you increase and you decrease based upon the transaction, you always had 2 accounts when you did it. As long as it stayed in balance on that accounting equation. That's called analyze. That's when you analyze it. We're not going to do that today, but just remember that's the first step in that accounting cycle. You have to analyze. The second step is what? You have to report into the general journal. You have to report into the general journal, right? Once you report into the general journal, you have to post to the general ledger. That's your T accounts. That's where you're in the general journal and the T accounts is where you got to use that framework, debits and credits. So we know, and I know we're going to get into something here too, which it won't talk about what I'm talking about now, but you'll have to use it in that. So if you got an asset, right? If you got an asset, how do you increase it with a debit or a credit? Debit. This is the framework I'm talking about. You decrease an asset with a credit. You have a liability. How do you increase a liability? Credit, right. If you got a equity account, how do you increase an equity account? Credit. If you have an expense account, how do you increase an expense account? Debit. Debit. That's all right. Debit. If you have a revenue account, how do you increase it? Credit. Those are the things we got to remember. The debits and credits, we have to remember, and that's the framework that this accounting is in. So what we're gonna do, now that we talked about the framework and what we're gonna use in this framework, chapter 1, this is what chapter 1 did. Chapter 1 took you to the end product. The end product is those financial statements. How many was it? You remember? 4. He said it was 4 statements. Who can name it? What's the first one we do? Income statement. Then the second one, statement of retained earnings. Then the third, balance. Now the fourth one is the statement of cash flow. You didn't have to do that. You'll meet that amount. Somebody that's majoring in accounting, you're gonna meet that down the road a little bit, doing the statement of cash flow. So what we're gonna start out with is doing those statements, and then we're gonna back into doing those transactions. So we're gonna use the data up here to prepare those statements right here. And the information up here was the account are the beginning balance. Remember, when you see that, those are beginning balances. Those are beginning balances. Those are your balances. What we're gonna do is we're gonna take these balances at this period of time, and we're gonna go prepare an income statement, a retained earnings, and a balance sheet. That's what we're gonna do. I'm gonna take you through that. So when we're preparing the income statement, what accounts are we looking for in the income to put in the income statement? What type of accounts? Revenues and expenses. All we're looking for. Remember that in your income statement, all you're looking for are revenue and expenses. And in that income statement, you're trying to produce what? Net income or net loss. So looking at this, we're going to pick out those income statement accounts. So we said revenues and expenses. So what are we looking at? We got a salaries expense sitting in there. We got utilities sitting in there. What else we got sitting in there, gang? We got service revenue sitting in there. We have the rent sitting in there. You got, yeah, you do have another rent. And what's that rent? It's an expense. Absolutely. So putting that together, I'm gonna show you the answer here. I'll tell you what I'm gonna do. I'm gonna give you a moment. See if you can put that together. See if you can put that income statement together for me. I'm gonna just give you a moment to see if you can put it together. And tell me what you did. And then we'll check out answer for that. Remember, you just told me the only thing goes in the income statement is revenue and expenses. Give me about 5 more minutes and you can put that together for me. And then we'll go over it. You need more time, raise your hand. You need a little bit more time? Okay. How we doing? We good? Everybody good out there? Tell me if you got this. The net income? The net income. Sounds about right. Y'all got 30, everybody got that?
Yes, sir.
Perfect. There you go. I'm trying not to show the other answer here, but yes, that's what we got. Let's take a look at it. All right. Can y'all see it back there? A little bit. So what we got here is we always want to title it. Got the title of the corporation. We got the statement that we're doing. That's net income. And remember the dates. The date line is very important, right? When we're looking at the income statement, we always use the term for the year ending, for the year ending or the periods ending. That's what we do for the income statement. Now, it's not that same for the balance sheet. I'm gonna show you the balance sheet when we get to it. It's not the same for the balance sheet because the income statement is done in a period of time. We're looking at it from this period to this period. That's all we're looking at when we're looking at the income statement. So in this case, we have total revenues of what we got? 80, what y'all got? 80,600? Yeah. Yeah. And you know that they break them down to service revenue and rent revenue. When you're doing accounting, you do want to break your revenues down. You may have sales revenue, you may have service revenue, you may have rent revenue, you may have interest revenue, but you always break them down because who's ever read the financial statements need to know where the revenue is coming from. And you say, well, why is that important? Well, if I'm buying a business and I'm buying a business that's selling, I want to know where's the revenue. If it's selling, I want to know that it's coming from sales revenue. Now, if all the revenue is coming from rent, I'm not buying that piece of the company, then that could be a problem for me. Because I'm like, hey, this most of the revenue is coming from rent, and I'm buying this sales portion. So that's why they always break that thing down into where the revenue is coming from. Now we got the expenses, associated expenses. We have salaries and wages. We have utility expenses. We got came up with total expenses. Here, let me get this out the way. Yeah. Total expenses of 77,300, giving us a net income, and you guys were right, 3,300. Now, what could create a net loss? You know we can have a net loss too, right? You can't have a net loss. Usually startup businesses have a net loss. How is a net loss generated? Higher expenses. That's right. If you have more expenses than revenue, it's going to create a net loss. Just remember that too. If you have more expenses than revenue, it's going to create a net loss. That happens. It happens all the time. It can happen. Now that we got an income statement, let's go back up. I want you to see if you can do the next statement, which is the statement of retained earnings. See if you can do that statement of retained earnings from me. Now that you got the income statement. Because we said the income statement was the first one we had to do. And the next one we had to do was the statement of retained earnings. See if you can put that together for me. I'm going to give you a couple of minutes to work on it. Statement of retained earnings. How we doing out there? Y'all all right? Good. Now let's just talk about it a little bit. Let's talk about it a little bit. What are we looking for when we say that we can? What are we looking for? A couple things that go into it. We need what? We need the beginning.
The income statement and dividends.
Add net income. And then what are we doing? We subtract the dividends, right? And that's going to give us the ending. I'm going to show you the answer. That's right. But let me say something about dividends a minute. Make note of this. Did you see dividends in your income statement? No. No. Remember, dividends is not expensive. They're not expensive. Dividends are not expensive. You're only going to see them sitting in this retainer. They'll pay out to you for your stockholders, what it is, but it's not considered an expense. That's why you won't see it in the income statement. Remember, it is kind of tricky, right? Also, I failed to mention one thing. When I told you about the accrual basis of accounting, and I told you cash basis was not GAAP, didn't it? And I told you accrual basis of accounting was GAAP. I want to ask this question. What does GAAP stand for? Generally accepted accounting principles. Make sure you know that. Generally accepted accounting principles. This is the basis about whatever we're doing in accounting. It's about GAAP, right? So let's take a look at the answer we got. And I think y'all got it because y'all told me how to do it. Did y'all get that? Can y'all see it? You can see, I know it's kind of hard to see a little bit. So you got 41,500. Is that what you got?
Yeah.
Yeah, that's it. So you had beginning retained earnings of 42,200, right? Is that what you had? And then you added in the net income of the 3,200. And then you subtracted the dividends of what it was. Dividends was what? 2,000. Then that gave me 41. No, is it 41 or 43?
43.
43. See that's screen is a little off. 43,500 is what we got. 43,500 is your answer. I'm gonna have to. I'm gonna make sure here. Yeah, 43,500. For some reason that screen here is a little fuzzy. 43,500 is our answer, right? But remember, dividends are not expensive. They're not expensive. So now, after we do the retained earnings, and notice the date on the retained earnings too, right? It's for the year ending. That one is for the year ending too. For the year ending. For the year ending. Make sure you know that for the year ending, for a period of time. For a period of time. Now that we have the income statement done, we got the retained earnings statement done. The next one we did, y'all told me, it's the balance sheet. All right. So we're gonna do the balance sheet. I want you to see if you can put together the balance sheet for me. Now, what goes into the balance sheet? What type of account will go into the balance sheet? Assets, liabilities, and stockholders' equity. There you go. Let me get the data back up, and I want y'all to put that together for me. Now put that balance sheet together for me, and I'm gonna give you a minute to work on that. Remember, we're looking at assets, liabilities, and stockholders' equity account. The only thing I should see in the balance sheet is assets, liabilities, and equity. I hear some mumbling going around. Remember, expenses are not liabilities. Expenses are not liabilities. And we use those expense accounts already. We use them in the income statement. So we can't use them again. You can't use them. Yeah. So remember, expenses are not liabilities. Although it may sound like it, but they're not liabilities. Remember, liabilities are what? It's something that you owe, right? Expenses is something that has occurred already. So it's happened. You pay it, or you're gonna pay it. Yep. Revenue is not an asset. Revenue goes into the income statement. So cash and revenue, remember, cash and revenue are not the same. When you go to the balance sheet, you gotta take the ending retained earnings, not the beginning. And I'm gonna show you that once I put it up. You gotta use the ending retained earnings, not the beginning. That's where it flows. It flows from the income statement. The income, net income goes into the retained earnings. You compute the retained earnings, and that ending retained earnings is what you're gonna flow over into the balance. If you don't flow that ending retained earnings in there, and what we're trying to do with the balance sheet, it needs to do what? It needs to balance. It's not gonna balance if you don't use the ending retained earnings. Use the beginning retained earnings, it won't balance.
So for, I think it was a statement of retained earnings, it said like that the year started, the previous retained earnings was from August 22.
Beginning.
And then the ending was like July,
That's
the
when
end
you-
of July.
When you calculate,
23?
when you calculate.
That's like, or, okay,
Yeah, you calculated the ending.
yeah.
Yeah.
So that's, what's that? Calendar year called?
That's
Is that
the,
the fiscal or?
well, they, yeah. Yeah, they're going from month to month.
Yeah.
Yeah, but that amount that you computed, that's the amount.
Yeah,
and
yeah,
that's what you need.
Yeah.
I'm gonna put the answer up. I'm gonna put the answer up on this. Y'all ready? No, you got a question? No?
Equipment would be like, yeah, right?
Equipment, non-current, that's right. You ready? Let's see what we got, team. And then we're gonna talk about that one a little bit more. Can y'all see that? Oh, boy. All right, let's look at it. Of course, we got the balance sheet and notice the date. The date says at. Not for the year ended, it says at. Because we're at a point of time. See, the accounts in the balance sheet are called permanent accounts. They just keep rolling forward. But the accounts that sit in the income statement account are temporary accounts. You're gonna end up closing them out. And you won't do it now, but when you get to chapter 4, you're gonna end up closing them out. They're only gonna be temporary. So that's why they use the term at, because it's a statement of condition at this point in time, because these balances have just rolled forward because they're permanent accounts. So now we got current assets first, right? We got current assets first. So we got cash and we got accounts receivable that's current assets. Now your balance sheet arranges those current assets in what they call liquidity order. Liquidity order says how fast can I turn this asset into liquid. That's why cash is always first. And then accounts receivable is going to always be second because the liquidity of it is quick. Because accounts receivable is what someone owes you, right? Is that what it is? Now, accounts receivable is current because it should be paid within 12 months. You know, that's the difference between current and non-current or current and long-term is it has to be paid within 12 months. It makes it clean. So that's why accounts receivable is up under there. If we had another one like supplies would be another one, but we didn't have it here. It would go up under there. That's also a current. You're going to have some more current assets that will show up in later chapter, but those are current. Non-current assets we got is the equipment. Those are non-current assets. That's equipment. And equipment was what we had 15,000. So you had a total current assets of 42,980, right? Total non-current. Okay. So your total assets should have been 57,980. Is that what y'all got? So that's the total assets. 57,980.
Wait.
Yep.
Can you just say what was supposed to be in the assets?
You should have cash, accounts receivable, and equipment. Should have been in your assets.
Oh, so equipment is in. Oh, okay.
Yeah. Equipment should be in. Equipment is a non-current asset. Non-current asset.
So if there were prepaid expenses an asset, right?
Yeah, prepaid expenses, that's an asset.
If it goes in that order of liquidity, would that go under accounts receivable?
Yes.
Okay.
Yeah. She said,
would it go like over supplies or how do you decide?
Supplies usually come up under accounts receivable, okay. But it's not gonna really matter. Okay. Yeah. So she asked about prepaid. Prepaid is an asset. So if you got prepaid insurance, you got prepaid rent, it will be an asset. You have that. Yeah. Okay. Hey, let me ask that question. What creates a prepaid? How's a prepaid created? You pay in advance of something. Generally an expense that's paid in advance. That's how it becomes an asset to be prepaid because you paid it in advance. Yeah. All right. So now, the current liabilities, did you have accounts payable? Had accounts payable of what, 4,100? And then we had salaries payable of 2,580. That gave us total current liabilities of $6,680. So that's our total current liabilities. Then we had notes payable, which is going to be non-current notes payable, because they told us notes payable was what? Let me go back and see that. It was due in 2026. And we're in what year are we in? 2023. So we know that's long term. That's what made it non-current. If it was a current notes payable, it would be due less than 1 year.
So since it's not, we don't put it in.
You put it in long term. So it's not in current. So you got total current liability, and then now notes payable gonna go below that. It's gonna go below that, and you're gonna sit it out here for the ATM.
In its own.
In its own. Yeah.
Okay.
And it's non-current. No.
Accounts payable always go first in the.
Generally it does, yeah. Yeah, generally it does. She asked me, does accounts payable usually go before notes payable? Generally it does. Yeah. You said anything that's a payable is going to pretty much be a liability. Yes, it is. Now you will have an account that won't have payable on you. Could you tell me what that would be? It's a liability, but it doesn't have payable. The name doesn't have payable in it.
So do you still put that like below in there, or
What's that?
like do you keep that off the balance sheet or?
No, it's on there. Notes payable?
Yeah.
Yeah, it's on there. Yeah, it's on there as a non-current. But she asked a question. A liability is generally stuff that says payable, and she's right. It is. But it's a couple of accounts. One account that's not. I see a hand back. You can tell me? There you go. Deferred revenue. Deferred revenue is an account that won't have payable. And sometimes they use the term unearned revenue. Deferred unearned revenue is the same. And that's created how? By somebody paying you in advance. You're supposed to do something, but they pay you the money up front. You're going to do it down the road a bit. So because they paid you in advance, that revenue won't be reported in revenue. It will be deferred. That's why they use the term deferred. Deferred means I'm going to wait to put that in revenue. The only time you can put it in revenue then is when you have done the job. Once you do the job, then it can go to revenue.
So it doesn't go on the balance sheet.
What's that?
The deferred revenue.
No, deferred revenue will.
Okay.
Yeah, deferred revenue is a liability. It's a current liability that will go on the balance sheet, but it won't have payable on it. So I don't want you to get confused and put it over in the income statement because it has revenue. Because that happens a lot. Because they see revenue on the end, you'll put it in the income statement. When it's deferred, that means it's a liability, and it's a liability because we haven't done what we're supposed to do yet. So if we don't do it, we have to give them the money back. Because that's why it's a liability. And I'll give you an example of that. Season ticket holders. I always use it. Season ticket holders. You buy your tickets in advance. Like FSU, FAMU, whatever. You buy it in advance. FSU don't put that ticket money in. I mean, that money that you give them in advance in ticket revenue here. They put it in deferred ticket revenue. Then when the game is played, then they will move it to ticket revenue once it's played. Because they're gonna play the game, they got to give you your money back. That's why it's in deferred. So yeah, that's the account you have to watch. It's a liability, but it's not gonna have payable. So where we at, y'all? So now we down to the stockholders equity section. Let me pull this up some. We're down to the stockholders equity section, and we got common stock, 6,000, and we got retained earnings. The ending retained earnings, not the beginning. They had the beginning up there. We need the ending retained earnings. Once we add the common stock and the ending retained earnings, we get a total stockholders equity of 49,500. Total stockholders equity 49,500. Now we have to check to see if this thing balances. And how do we do that? We add liabilities, total liabilities, and total stockholders' equity. And when we add total liabilities and stockholders' equity, it comes up to the 57,980, which is equal to the total assets. That's where it balances. That's where your accounting equation is. Your accounting equation said assets has to equal what? Liabilities plus stockholders' equity. That's what your balance sheet is doing. It's balancing out. And that's how you know you balance. If this doesn't balance, you got to go back and figure out what is it that you did wrong. Yes.
So I'm kind of caught in the current and non-current.
Okay.
Regardless of that, it's still going to go into the life. Like it's
Oh,
not.
Yeah, still adding in the total liability. It is. So how y'all feel about that? So we went from the income statement. We transferred the net income into the return earnings statement. And we took the ending return earnings and we transferred it into the balance sheet. That's why you have to do it in order. If you don't do it in order that way, it would not balance. It would not balance. So I just probably gave you a few answers to the question, right? Remember, the order has to be that way. The order has to be that way. Now that we know how to do the final product, because this is the final product, this is what GAP is trying to get you to do, is get to these statements and to send them in a way that's going to be reliable, that someone can look at and make some decisions. But we get to this point, right, by doing and recording transactions. So what we're going to do next, we're going to flow into recording these transactions into the general journal and put them up. I want you to record those. I want you to record these transactions. Let me see if I can open it up a little bit more.
Is there any way another like balance sheet, like a different one with different numbers, just so you can just go over it again?
We don't have time. Yeah. If you who did you do? What? Yeah, just ask. Should have been. I want y'all to do this for me, because you're gonna have to record transactions. And this how the information gets into the balance sheet and all that. It gets in there through these transactions. You gotta capture these transactions and you have to post them to the general ledger. The general ledger are the T accounts. That's what it is. You see the T accounts? That's your general ledger. That's where all your accounts are, and that's where your accounts get updated. And the only way it gets to the balance sheet is through that T account, right? Y'all remember doing T accounts and then taking that balance, and then after the T account balances, you had to do something. What you had to do? A trial balance. After you did the T account, you summarized the T account, you had to do a trial balance. Now, we're not going to do a trial balance today, but remember, you have a step that you have to do that trial balance. And the purpose of that trial balance, who can tell me the purpose of that trial balance? Make sure the debits and credits are in balance. Y'all remember that. Make sure those debits and credits are in balance. Now, I want you to try these transactions, and I want you to post it. I mean, not post it. I want you to record, because you're recording it in the general journal. That's debits and credits. Debits and credits. And I'm gonna give you a moment to see if you can do that for me. Do your general journal, record each of them, and then we're gonna come back and talk about those recordings. Yeah. Remember, in each of your transactions, you have to have a debit and you have to have a credit. It's like the debit or credit. Yeah. Yeah. Gotta have a debit, gotta have a credit, and the debits and the credits must balance every transaction. There you go. Same thing. Yeah. We didn't think that. Yeah. Yeah. We need a few more minutes. We're gonna look at it. Remember, when they say on credit or on account, that means what? Accounts payable, right? Typically. Or from the beginning. I do. This get it right quick. It's reference you saying. There's something that you get it right. That's what you see. It's made that one example. So what's happening? Okay, it's basis. And the cash decrease. So now you get the thought process is understanding how why decrease cash. Be right back. All right. I was against the
or no, it's
You'll be able to get it. All right, I know it's where it gets good at that. It's where it is right here. So I think no, he didn't. Yeah, this is a little tricky, y'all. Let's go over it. Let's go over it. Let's go over it. Let's see if we can talk about this. Right? Let's talk about each of these transactions here. Because this is where it's at. These transactions. These transactions is where you have to understand that the debits and credits, or that frame. What you have to do is you have to analyze the transaction and say, okay, in this transaction, what am I trying to do? And in this case, in number one, it says issue common stock, right? I think most of y'all got that. Issue common stock. I think most of y'all got that. So let's go up and see what it is. I'm gonna have to keep going up and down on this one. You issue common stock, which means let's go down to it. Go down, go down, go down. See that? Most of y'all got that one? So you got a debit to cash, and you got a credit to common stock. So y'all, you guys are okay with number one? Y'all okay with number one? Common stock is credit. How about number two? Number two said, let's see what number two said, right? Number two said, you purchase $500 of supplies on credit.
So on credit means accounts.
On credit means accounts payable. Or you could say promise to pay or something like that. If it didn't say cash, then you don't put cash. Now, in some cases, it could say cash, but in this case, it was on credit. So you're gonna debit supplies, and you're gonna credit accounts payable on that. They're both going up. Absolutely, they're both going up. How about number three? Did anybody have a problem with transaction three?
Oh, can you go over number four?
Number four?
Yeah.
Well, let me hit number three right quick. Number three says you purchase equipment for $25,000, paying $3,500 cash down, and the rest you signed a note for. So in that case, this is called a compound entry, which means it still has to balance. I want to go back to that. That entry still has to balance. So you got a debit to equipment because $25,000 is what the equipment is worth, right? We put $3,500 cash down, so of course our cash is moving down, and then we put the rest on a note. So if you add these up, you're gonna have $25,000 here and $25,000 there. Remember, your debit and your credits has to balance in each transaction. So let's move to four. She was asking about four. And then four says you paid what, 2,050, not 2,000. You paid 250 cash on account to office supplies purchased in transaction two. Now what's going on there?
Paying off your account.
You paying on your account that you created back there in transaction two. Which means you got to reduce that accounts payable. You got to reduce that accounts payable. We reduce an accounts payable with a debit. When you look at the framework, it's a liability, and you reduce liabilities with a debit. That's why you're debiting accounts payable and you crediting cash because cash is going out. And remember this, your general format is you put your debits first and then you credit. That's your general format. Debits goes first and then your credit goes second. So let's look at five. Five is something too. Five says this. And let me pull this up for my folks up online. Let's look at five. Let me pull it back up to five. Five said pay rent for the months of August, September, and October. So we're in July, right? So that means we paid it in advance. That's why you see prepaid rent, because we paid it and we haven't used it yet. We haven't rented the space. We haven't used it yet, so we paid it in advance. That's why. And prepaid rent is what type of an account? It's an asset. It's an asset. It's an asset. That's why you don't see rent expense there, because it's not an expense yet, because we paid it in advance. It will become expense later, and you'll see that in chapter 4. They'll start showing you that in chapter 4. You'll see how to deal with that. Yeah. Yeah. For number 5, you got to do prepaid. You got to put prepaid. Anything you pay up in advance is going to be prepaid. It's going to be an asset. All right, it's going to be an asset. What's the number? We know number 6 was pretty simple. You pay salaries, so you're going to debit salaries and wages, expense, and credit cash. That's pretty simple there. Number 7 said you perform services and collected cash from customers. So of course, you perform services, your cash is going to go up, and your service revenue is going up. So that's pretty. Now where it gets a little tricky at is probably number 8, right? And let's I'm gonna put this down for the viewers online. Number 8 says, number 8 says perform services and build customers on account. Now, sometimes students like to get that mixed up with accounts payable. What ties it, the reason why it's not accounts payable is because it says you build customers. Customers is tied to what account? Accounts receivable. The minute it says customers, they're talking about accounts receivable. So in that case, because you built them, you didn't get the cash. You did the service, which is a revenue created once you did the services, but they didn't pay you. Because they didn't pay you, it's accounts receivable.
So what's the difference between like deferred revenue? Is that like?
Thank you.
All right, that take care, man. Say that again.
I read that.
Yeah. Okay. That deferred revenue is not an actual revenue. It's a liability. Yeah. And you can mix that up. You can mix it up because it has revenue in it. Just remember, deferred revenue is not a revenue account. It's a liability. And you can mix it up. So in this case, we got the accounts receivable and we got the service revenue. They're gonna pay us later. They're gonna pay us later. Which is in number 9, it said collected $750 from a customer on account. When they say collected from a customer, they tie it to accounts receivable. You don't see it up there, but that's what they're doing. They tie it to accounts receivable. So the cash is in, debit, and we're going to reduce the accounts receivable because the customer has paid on it. Number 10 says you borrow $15,000 cash from a local bank. Get this up for the folks online. Borrow $15,000 cash from a local bank, payable in 3 years. So we know if it's payable in 3 years, it's a notes payable, right? Is it long term or short term? It's long term, absolutely. So we're gonna go and we're gonna bring in the cash right here. We're gonna bring in the cash and we're gonna go ahead and credit the notes payable. Yes. Oh, let's talk about that. He said, why is it's notes payable and not accounts payable? It didn't actually say notes, but this is the deal. If they got it from a bank, it's no way, it's gotta be a note. Because they're assuming you're gonna know that you can't get it from a bank and walk out and it's accounts payable. They're gonna assume you can get it that way. They didn't actually say no, they just get your bank, yes.
Why is cash first and deferred revenue get cash? Yeah.
Why is, oh, this is why. Now she's talking about number 11, right? Okay, that 11 was worded. I saw that it was worded. Let's go back up to the viewers on the line because I'm pretty sure that it was worded, some of them too. And let's look at this. It says, number 11 says, on the last day of the month, you receive $1,300 in advance. You got it in advance. You haven't done anything yet.
So why isn't it the deferred percent?
No, it's not deferred first yet because deferred is what type of an account? It's a liability. So how do we increase a liability? A credit. That's why I got credit. Because you got the money too. You got the money, so it's a debit to cash because you got it. And remember, your debits go first, and then your credit. How y'all feel? Y'all all right? I think y'all will do all right on that. Any questions that you may, I know we're running out of time here, but any questions you guys may have that's. Yes, it's going, he's talking about the format. It's going to go debit and then credits, absolutely. I think that's it, team. I know we take a little longer than we know, but hopefully y'all got something out of it.